So today, this session is really about taking your questions. Dr. Brett Steenbarger and I would like you to throw out your questions regarding trading psychology and trading in general. Any questions that you may have, we want you to take something from this that will help you to become, hopefully, a better trader. So start loading up your questions, throw them in the Q&A chat box, and the two of us will do our best to try and answer your questions. So without further ado, though, let me introduce Dr. Brett Steenbarger. Hello, welcome.
Hi, thanks for having me. Can you hear me okay?
Yes, it sounds great. How are you today?
Awesome. Yeah, doing very well, keeping plenty busy with these markets, but
yeah, they're
doing fine, thanks.
Yeah, they're pretty volatile as of late. So why don't you go ahead before we start, and while people are loading up their questions, and you can give a little introduction about yourself.
Sure, happy to. I'm a psychologist and have taught at a medical school in Syracuse, New York since 1985, so I'm dating myself. But I've traded financial markets since the late 1970s, so I'm dating myself even more. And in addition to being an academic psychologist, I ended up writing a book in 2003 called The Psychology of Trading. So I brought those two interests together, and that led to my working with a trading firm full-time in Chicago, and that led to working with a hedge fund full-time in Connecticut. And right now I work with a number of trading firms, prop firms, hedge funds, asset management firms, helping investors, helping traders with their performance, helping them be the best they can be at what they do.
That's great. And also, I have this book from you, The Daily Trading Coach.
I've seen that.
Yeah, which I find is a phenomenal book because it is 101 lessons for becoming your own trading psychologist. And if you read through that, just one lesson a day, it's 3 pages, and you go through the whole book, there's 100 things you could have done, or 100 lessons that you will have within 100 days. So I found that very helpful and very easy to read. So thank you for that.
Thank you. Thank you very much. I intended that as a kind of cookbook, a trading psychology cookbook for traders. The goal is not for me to be someone's trading psychologist. In fact, I don't market myself that way. The goal is for people to learn those psychological techniques for themselves and help their own performance. So the book was an attempt to give people the opportunity to learn how to fish rather than just give them a fish.
Yeah, and that is and that's great. Just to let people know a little bit more about myself from a trading perspective, I have worked at SAC Capital hedge fund from 2000 to 2018, later changed the name to Point 72. I was a futures and a currency trader while I was there. And I used to, at the beginning, Dale, you'll appreciate this. I used to call down the pits and say, buy 5 a handful soybeans DRT. I'm sure you remember that one, Dale. So I've traded everything from S&Ps to NASDAQ to Hang Seng, bonds, 5 years, 10 years, 30 years, gold, silver, oil, natural gas, sugar. You name it, I probably have traded it in the futures market, and also currencies. So
Did we just lose
18
Joe?
years a hedge fund, and now I am out. I hooked up here. Oh, can you not hear me?
You lagged out for a few seconds.
Oh,
yes.
Okay. Well, I was just where did I leave off? What was the last thing that you heard?
Not sure, Joe. I was keeping notes actually. So sorry.
Okay. So I was just going over all of the instruments that I've probably traded in the futures market and saying that I have a lot of experience trading futures and currencies. And now I'm with you guys at Forex Analytics, Global Head of Business Development. Go on Bloomberg, CNBC, not CNBC, Bloomberg and Real Vision, moderate panels for the CMT. just trying to get the Forex Analytics name out there and try to get as many people involved in our Forex community as possible. So, having said that, why don't we go right into some questions here, Dr. Sternberger, and we can we'll get going. So let's see where we are. Let's see what we have here. Okay. So first question we have here. I'm a professional long-only money manager. I would like to know more on what metrics, charts, and other monitorables you use to have better entry-exit timing. Would you like to address that first, Brett?
Yeah, that's a trading question,
Yeah.
and I have some information on that on my blog. The blog is TraderFeed, TraderFeed, traderfeed.blogspot.com, and I have some blog posts on this very topic. Part of it depends on the average holding time. I work with very short-term traders. In fact, by start in Chicago, the average holding time for positions was 6 minutes. And so the quality of entries and exits becomes very important when you only have a holding time of 6 minutes. I would say for equities, I trade equity indexes. For equities, there are two major data sets that I use to help me with entry-exit. The first is the what are known as the tick statistics, T-I-C-K, which is the number of stocks trading on upticks minus the number trading on downticks at any particular time. The most common measure is the NYSE tick, which takes all the NYSE shares together, how many are trading on upticks minus how many are trading on downticks. But there are tick statistics for the NASDAQ 100, for the Russell 2000, for the S&P 500, and so forth. So by looking moment to moment to moment to moment at the flow of upticks and downticks, you can get a very good sense for where selling flows are coming in and price is holding and the sellers can't get it lower, the sellers can't get it lower, and then you see buyers coming in, and that's a great point for short-term entry. The second set of statistics I use are known as delta, which looks at each transaction, let's say in the S&P futures, the ES futures, and you are looking at whether that transaction is occurring at the current market offer price or at the current market bid price. So imagine looking every transaction, you can see the volume, lifting offers, hitting bids. You can see buyers being more aggressive, sellers being more aggressive. It's just another way of looking at the buying and selling flows. And again, you can see those selling flows drying up, and then you see the buying come in. That becomes a great entry point for a long-only manager.
I would also add to that as well that when you're looking at your entries and exits, now I haven't traded really that short term. 6 minutes is pretty short. Mine were more a couple hours. I was more of a swing trader, a couple hours to even a full day or a day and a half. However, you should have a trading plan and you should have your entries and exits in your trading plan and know already where you're going to get out, and if something changes, make sure that you stick to your plan, because there's a lot of uncertainties that happen, obviously. So you have to adjust on the fly. But if you have a plan and you stick to your plan, I think that is really good for using your entries and your exits.
Can I say one more thing, Joe? So this is going to be a shout out to John Ehlers, E-H-L-E-R-S, who has done great quant work on cycles in market data, and he's created indicators that are better than the standard technical indicators that we typically see. So, for instance, he has what's called an adaptive moving average that adapts the length of the short and longer term moving averages to the dominant cycle length. It smooths those averages so that when you get crossovers of the short-term moving average with the longer-term moving average, those tend to be more reliable signals. You get fewer whipsaws. That has been a nice timing tool for some of the managers that I work with.
Okay, great. So let's move on to the next question. What do you find is the greatest impediment for traders to become better?
It's a great question. The greatest impediment to becoming better is the reluctance to innovate. Markets are always changing. Patterns in markets are always changing. Participants in markets are always changing. And so we always need to stay ahead of the curve. And so every successful trader I work with is always discovering new things, working on new things, finding new sources of edge. A reluctance to do that, a need to just stick with one thing, ends up creating dinosaurs.
So there you go. Make sure that you change with the markets. Do you have any tips to overcome consecutive trading losses mentally?
The best mental technique for dealing with consecutive trading losses, and we all have consecutive trading losses. You know, if we have a 50-50 win rate, then we can calculate very easily the odds of having 4 consecutive losers. And for an active trader, it's going to happen. So we all have consecutive losers. The best mental technique for dealing with consecutive losers is good risk management.
Yes.
In other words, you limit the amount you lose on each trade because you know in advance you're going to have 4 consecutive losers at different times. And you don't want that to dig a deep hole. So for instance, with the traders, for instance, the active traders I work with at SMB, they will risk a fixed fraction of their daily loss limit on each trade. And that allows them to have a few losers and still stay in the game. And when they can stay in the game for the day's trade, guess what? They can stay in the game psychologically.
Right. Money management is so important. And I don't know if anybody has ever seen that chart before, but if you lose 50% of your capital, you need to make 100% back in order to get back to where you were.
To break even, absolutely.
Yeah, that's a pretty tough one.
Yes. The other technique, well, it's not really a technique, but the other thing that helps people weather consecutive losses is just stepping back, taking a break, and saying, okay, something's wrong here. The market's not moving the way I anticipated. Maybe I thought there would be a catalyst, and I'm trading off that catalyst, and guess what? It's not catalyzing. What's that telling me about buyers and sellers? How might I adapt to that circumstance? So you want to turn your losing trades into learning experiences. You want to be able to take something away from them. Maybe something about your trading that you can improve. Maybe something about the market that you hadn't taken into account. So that every loss at least has some learning P&L.
Right. I would agree with that as well. And also, you know what I would say? If you find yourself with 4 trading losses in a row, let's say, you should stop and get up and walk away. Especially if you're a short-term trader. Walk away, go get a cup of water, go to the bathroom, go for a walk, get your mind together, and then come back and sit down again. So that's another idea, I think.
Absolutely, absolutely.
Next question is it's more of a trading question. What's the best MACD and RSI period tweaks in your experience for day and swing trading? So for me, myself, I think that's going to be personal for every individual. However, for myself, I use mainly the RSI, and I stick with the 21-day period for that. However, having said that, none of these oscillators can be used alone, I don't believe. You need to be using them in conjunction with other indicators or price action or chart patterns where you can actually get confirmation that the oscillators are working correctly. So I stick with the basic default one. However, I wouldn't use it by itself.
And I would say if there was an oscillator you could use by itself, it'd be pretty easy to code it up and just run it as an algorithmic trading system. No, seriously. I mean, you can't use these kind of indicators in a mechanical way. And if you test them out, and I have, they don't work across market conditions. That doesn't mean they're not helpful. A technician once said the indicators are like a weather vane. They're not a weather forecast. A weather vane tells you which way the wind is blowing. That's helpful. It's not a weather forecast. So for instance, I will use a short-term RSI. Now, my charts are going to be different than most people's because the bars are in volume. I don't look at time-based bars, and I'd be happy to get into that if people are interested. But anyway, so I look at an RSI of the volume-based bars, short-term, and if I see an oversold short-term RSI at a higher price low, that's telling me the market's in an uptrend, and this is a dip in the uptrend, and I can look at that as a candidate to buy with the idea that the previous low could be a logical place as a stop, and that we should at least retest the highs. And especially if that lines up with a larger time frame, just that alone can be very helpful.
Oh, I think I would like to get into that conversation with you at another time regarding the volume-based time frames using that. That sounds very interesting.
Yes. You basically want time series that are as stationary as possible. Right. And people look at bars on charts where the volume and the volatility are quite different from one time period to another, and they expect the same patterns to occur, and it doesn't work.
Yeah, that's happened to me a lot.
All of us. Yeah. The only expertise I have in markets is I've made every possible mistake. I've traded since the late 1970s. I guarantee you, every single mistake. The stuff I write about in trading psychology, I've made all those mistakes.
All right, let's go on to another question here. What would you tell someone who is new to trading and they're wondering if they have a future in this field? So is trading for them? What are some good indicators or some good qualities that you could look at in a person in order for this person to determine if they may have a future in trading? Can you expand on that?
Yeah. And, I teach in a medical school, and the way that medical students figure out if they have a future as a surgeon, as a psychiatrist, as a pediatrician, they try it out. They actually do rotations in the different medical specialties. Mm-hmm. And that's what you want to do during a training period as a trader. You want to try out different kinds of trading. You want to try out different kinds of markets. And that will allow you to see what makes sense to you, what might you be good at. It's like sports. There's so many different ways to succeed, different sporting events. The sprinter is not like the distance runner. Mm-hmm. The long-term investor is not like the short-term trader. So you want to try all those, see what the results are like, and then you can really practice, hone skills, gain some mentoring, hopefully, which ends up being very important to success, and try to develop yourself.
Okay.
Most traders are so eager to make money that they go ahead and open an account and they start trading before they have really done those rotations, before they've really explored the different types of trading, and little wonder they lose their money.
So is there a way to improve your learning curve?
Oh, many ways. Yes, absolutely. And it's one reason I participate in that training program that SMB holds, because we have a structured process for doing that. That's actually somewhat similar to the process in medical school. But you need practice. You need a way of actually keeping statistics on your trading,
Right.
see what you're doing well, see what needs to be improved, and then you set goals for improvement and try those out, see what works, see what still needs to be improved. And so it's a constant iteration of what's called deliberate practice. We are practicing skills, getting better, getting better, getting better, just like an athlete would, if they're working on something in their game. That is very different than just going over charts, reading books, listening to videos.
Right.
We don't learn skills in that way. We learn skills by doing. It's true in sports. It's true in performing arts. It's true in trading.
Yeah, it's true. It just practice, right?
And in most fields, whether it's you're learning medicine or whether you're learning acting or you're learning chess, you need a mentor. You need someone who can guide that learning. It's very difficult to do in isolation.
Yes. Do you believe a community of traders is better? It's something that we try to emphasize at Forex Analytics, but having a trading community seems to be much better because, as Dale put it, you only have one set of eyes, and having other people there can really help you to generate ideas.
Yes. Communities can incorporate a lot of noise, and communities can attract really good people. And so a big challenge, I think, when you join a community is separating out the chat, the noise, from the real learning. And even if you only connect with one or two other traders who are serious about learning and who are doing things similar to you in their learning curves, that can be a tremendous aid, having a buddy to learn with.
Yeah, not only that, if you're trading by yourself, it gets pretty lonely. It gets pretty lonely, and your mind can drift off, and sometimes you do things that you don't want to do as far as executing trades or things like that.
That's really interesting. It gets into a fascinating area of psychology, which is more the cognitive area and how we process information. There are some people who process information by talking out loud and sharing and interacting. Right. There are other people, I'm one of them, who would find that totally distracting. If someone started talking to me about their trading ideas while I was focusing on the market, I would tell them to shut the F up. Seriously, like, I need to focus. What the heck?
Right.
I'm joking. But seriously, we all are wired differently cognitively, and in a community, you can find people who are wired like you. And you're right. That offers a kind of camaraderie that can be really helpful.
Okay. All right. Really good. All right. Let's move on to another question here. Somebody says, after the market moves against me, I seem prone to just take smaller profits. Any suggestions? So basically, it seems like, they get a little nervous after a couple losses, and they want to make sure they capture some small profits rather than sticking to their plan.
Yes, and of course we can just think of that purely mathematically, that if you let your trades go to their stop, but you cut winners short, the distribution of winning trades and losing trades, you're going to have larger trades on the losing side, the left-hand tail of returns, than on the right tail. So that ends up being problematic, obviously. If a losing trade is affecting you that much psychologically, it may be the case that you're risking too much, or at least too much for your own personal risk tolerance. So my leaning would be to trade smaller size in dealing with the situation, go through your losing trades the way we all do, but it won't cause so much of a drawdown in dollar terms that it would hamper subsequent trades. If it's more a matter of a psychological pattern where we get into losing trades and then we start entering a losing mindset, then that's where those psychological techniques, like you were mentioning in the Daily Trading Coach, come in handy. I have a series of 3-minute videos for trading psychology called the 3-Minute Trading Coach. And it's free. It's a YouTube channel. And I have specific techniques that people can use to mentally prepare themselves for inevitable losing trades so that they won't be thrown psychologically.
Right. I find that as well. As long as you have yourself mentally prepared and you know how much the maximum that you'll lose is based on where you put your stop, then you'll be comfortable with it. So I agree with you there.
Right.
Well, I agree with you in a lot of areas, but definitely there. Here's another question. Someone here says, day trading versus medium-term trading. If I find holding a position for a few weeks to months much more profitable. Is this a personal issue or is this more common?
Oh, interesting. Okay, so holding for weeks to months. Clearly that starts to get into what I would call investing rather than trading.
Right.
Yeah, and in that situation, you're really looking at different variables as far as what causes a market or a stock to go up or down. If I'm holding a stock for months, the fundamentals of that company are going to be much more important than if I have a holding time of an hour. In an hour, the fundamentals don't change that much. But over a period of months, there could be earnings reports, there could be different catalysts. And so it really is a different preparation, a different data set, and some people are better at big picture thinking than that quick pattern recognition that's typical of trading. It's how we're wired.
So it's really a personal choice.
Well, you know what? I don't even think it's a choice. I think we're wired the way we're wired. And hopefully we find our niche. We find what we're good at. A number of very good hedge fund portfolio managers I work with would be terrible day traders, horrible. And a number of great day traders would not know the first thing about putting together, assembling, constructing a portfolio. So they're just different skill sets. And our task is to try different things and see how we're wired and see what we're good at and go for that.
Okay. What's better, initiating a stop loss, mental or programmed, when putting on a trade, or buying puts? I also use Bloomberg or risk ranges when trading. I always use stops because if you're buying puts, it may be a little counterproductive to what you're trying to do. However, I have not considered doing something like that. Do you have any thoughts on that?
Yeah, it's a totally different thing. There are occasions where buying a put can be a worthwhile hedge. If let's say you had a longer term view, but you wanted to limit your risk in holding that position, you could buy a long-term put, and if vol was not priced ridiculously high, you're going to pay something for that insurance, but it guarantees you won't lose more than a certain amount. So there are situations, obviously, but as a routine matter, if you're buying puts, then you're now you're changing yourself as a trader. You're now long vol, right? Because if the market stays flat, your stock position will be flat, and you'll lose money on the put because the premium decays. And so you're always long vol. And do you really want to be long vol on an ongoing basis? That's a different bet. The thing I like about stop losses is that it forces you to look at the downside accept the downside, process the downside. It's very hard to emotionally overreact to a losing trade if you've already anticipated the stop, if you've already thought it through, visualized it, set the stop. So I think psychologically there are real advantages to having stop levels.
Okay. Yeah, I kind of agree with, I always use stops, whether they're mental stops or physical stops. One of the things that I learned from Blake Morrow is that you should have a stop for your trade and also have a stop for your portfolio, pretty much. Here's the stop on my trade, but where is if you want to use that as a mental stop, but where is the absolute worst possible place if for example, the SMB comes out and cuts their peg to the euro as it did in 2015, and Euro Swiss dropped from 120 down to about 85 in a second. So you want to have if you want to use a mental stop for the trade and then another stop for basically saving your portfolio, that helps as well.
Right. I also, and this is a purely personal thing, I also like the use of time stops. So let's say I'm taking a breakout trade. Something is trading in a narrow range, and then we see a breakout, maybe on higher volume. Maybe that breakout is confirmed by other things that are trading in sympathy, that are correlated. I might go after that breakout, but if it doesn't stay higher within X amount of time, I'm out.
Right.
In other words, it's either going to break out and it's going to make a Momo move, it's going to show momentum, or not. And so I'm not going to wait for the whole thing to reverse and dump. A time stop can be useful in certain circumstances.
And again, that would be part of your plan, right?
Absolutely. It's how you learn to think about things, and that comes from doing it the other way and losing money that we all learn from hard experience.
Right. Next question here is for me. What is the most common factor to deal with? What is the most important factor to deal with under performance pressure? It says, given your background. So because I worked at SAC, there is performance pressure, but I would say that there is performance pressure for anybody, not just because I worked at SAC in .72. And I think that the number one way to deal with performance pressure is to be prepared. Make sure you're 100% prepared for all circumstances, and have a daily routine. And wake up in the morning, look at your trades, look at the charts, look at the news, contact everybody that you can, expand your network, find out better ways to do things, and adjust as you're going through it. So if you find that you're not having as good of a month as you would like to, for example, go over and review what you're doing, and perhaps change your plan or change your routine in order to find something that will help you do better while you're trading.
Yeah, that sounds very, very good, Joe. If people go to my blog site, the Trader Feed, there's a link to a free blog book. It's a book that's written as a blog on the spirituality of trading. And so it's a little bit different than psychology of trading, but it looks at spirituality. And one of the points I make in that blog book is that we can deal with setbacks in trading. We can deal with performance pressure if we always have things in life that are more important to us than P&L.
Right. Right.
My relationships, my family, my health, my own spiritual beliefs and practices. If we have things that are meaningful to us, beyond P&L, it's much easier to weather the performance pressures because our whole self-esteem is not wrapped up in our P&L.
Right. Boy, I got to tell you, you walk away after a bad day, and then you go out of the office and you go home, and you have something else to look forward to or to get your mind off of it, is really a big help in that situation. So when you
Absolutely.
look outside of your trading for other things, that definitely is helpful.
Yes, the way I put it with the traders is trading has to fit into your life. If your life is fitting into trading, there's going to be a lot of pressure, a lot of stress.
Okay. Boy, the questions are really coming in here.
All right.
Which is fantastic. All right. Here's an interesting one. This one would be for you. From a non-investment discipline, would you take the best rules to implement into behavioral finance? So from a non-investment discipline, would you take the best rules to implement into behavioral finance? What are your top 3 psychological tools to master investment bias?
This is a really good question. And one of the challenges I have in answering it is that I don't think that bias is best dealt with or is only dealt with through psychological tools. So for example, if we have solid processes that ground our risk taking, if we understand how markets move and we have studied patterns in markets, that grounding in patterns is the best way that we can get away from any emotional biases that we might have. I do think, toward the person's question, that keeping a journal in the right way and writing our thoughts, talking our thoughts aloud, allows us an objectivity on our thinking. We can read over what we've written, we can listen to what we've said, and that gives us a different perspective on our thinking and allows us, as the novelist philosopher Ayn Rand used to say, allows us to check our premises. It allows us to rein in our biases and think about our thinking, and that could be very helpful.
Okay. Well, another question here. Somebody wanted to see the book again. The book is the Daily Trading Coach. I don't know if you could see it with the background, but it's called the Daily Trading Coach.
Yeah. It's called the Daily Trading Coach, and that's brought by Wiley. And if you go on Amazon and just type in my name, you'll see more than you care to look at. So
someone wanted to know, as a beginner, from that book, or basically now from your YouTube channel, do you have any advice for beginners in trading? For beginners that are just starting out, they're just, where's a good place for them to begin?
A great place to begin, actually, where I began trading, it was, like I said, it was in the late 1970s. And so we didn't have all the computer resources back then. But what I did for a full year before I started trading live was study charts, study indicators, study indicators. And then when I had my little dot matrix printer, okay, I'm really dating myself.
I was going to say, that was a long time ago.
That was a long time ago, man. So but I would, on my dot matrix printer, I'd print out all these charts, and every single day I'm looking on the charts, and I would look at what were the 1 or 2 best trades of the day that set up, and what could I have looked for? What were the patterns? And I did that day after day after day without placing a single trade. Now we can do it so much more efficiently because we can trade in simulation mode. there are many platforms that allow us to do practice trading where our hard-earned capital is not at risk. And so it's like going on the playground and practicing your basketball game. I used to do that at Duke all the time. Once in a while, I went to class at Duke. The rest of the time, I played basketball. But you get on the court and you play, and if you want to try a new move, you want to, it's not like you're doing it in a varsity game. Mm-hmm. So you preserve your capital during your learning curve. You do the practice trading. Mike Bellafiore talks about the idea of playbooking trades. You create a playbook where you actually write down how the trade sets up and what you look for and what you do. And you cement that, you practice it, you get good at it, and then you go live. And that way, the beginner is increasing the odds being in their favor when they start out.
So that's always a question that comes up is it better to demo trade first or go in with trade with actual money using a small amount? Because you get that feeling when you're actually risking the money, where you'll take chances in demo trades that you may not actually do when you're in demo trading. Yeah.
Okay. So is a surgeon a beginning surgical student? Are they going to first work on a cadaver or on a live body?
On a cadaver.
Okay. Because above all else, do no harm. No. You want to first get good on demo, because if you can't be successful in demo, there's no way you're going to be successful, with the pressures of live P&L. You're absolutely right. The demo trading doesn't substitute for live, but it allows you to practice. It's like going on the playground and practicing your basketball game. It allows you to practice, see what works for you, and then you go live small, get consistent with your small trading, and then you grow your size and your risk taking. So I see it as a developmental progression, but trying to short circuit that and trade risk right away, I just see people losing money and damaging themselves psychologically.
Okay, that's a good answer. We have time for one or two more questions here. This is a good one. What would you advise someone who's dealing with guilt and lack of abundance, which is affecting his trading?
Guilt over what? In a personal way or in a trading way? It depends what the source of the guilt is.
That's a good question.
This is back to what I wrote in the blog book about spirituality of trading. The book is called Radical Renewal. Every major religion has a way of dealing with guilt, of dealing with our shortcomings. And the way we do that is by finding forgiveness. And we do that in different ways. We might need to do it in our marriage. We might need to do that in terms of learning from our mistakes and learning to let them go and learning to forgive ourselves. We may look for forgiveness in a more spiritual and religious context. But the way we deal with guilt is by accepting our shortcomings, learning from them, finding forgiveness, and using that experience to make us better human beings. That's the whole idea. Guilt is not a bad thing. Guilt can be a stimulus to help us make changes, push us to make changes, and to become better.
Okay, great. Well, I'm afraid that our time is up here. It is 9:30, and we have our panel discussion.
Awesome.
Thank you very much, Dr. Steenbarger, for joining us here today. I think we probably helped a lot of people, go through some of their trading performance issues, and hopefully people got something out of this that they can.
Good. And for folks who may have had questions that we didn't get to, if you go onto my YouTube channel, the Daily Trade Coach, that's my book. Okay. showing my age in a different way. If you go to the 3-minute trading coach, the videos, there's a section where you can type in your questions, type in your comments. So if you have questions, that's a great place to ask them, and I'll go through them and answer them through the video chat.
Great.
What a great interview.
Great.
What a fantastic interview, Brett. This is
Well,
Dale
thank
Pinkard. Joe, a great job. And you know what, Brett? Could tell that you are a teacher because you have a giving, sharing nature. And I believe you think this: what good is anything until it's shared with another?
Well, it's a good point. In sharing, we double our blessings. And so, yes, there's a lot to be said. And it's one thing that makes trading in a community very powerful, because it gives us many different ways to share.
Yeah, Brett, don't you think that when it's all said and done, we're not going to be thinking about our greatest trades? We're going to be thinking about our relationships?
Yeah, you know, I visit cemeteries. I look at gravestones. I've never seen an epitaph that says, "He bought the breakout."
Have you ever seen a headstone that said "stopped out"?
Yeah, right. He bought the dead ass loads. No. That's at the end of it all. That's not what it's about, and it's all good. Yeah.
All right.
All right.
Thank you so much, Brett. Joe.
Thanks,
Thank
Brett.
you
very
for having
much.
me.
Thank
you
you.
very much.